Hello and welcome to this week's Market Outlook webinar with me, David Jones, and Ayondo Markets. If you're watching the recorded version of this, it was held live on Wednesday the 28th of June at 12:30 in the afternoon. So this is a webinar that we do every week on a Wednesday lunchtime usually, and it splits down into two parts. It runs for half an hour and we take a look at some interesting markets to keep an eye on in the days ahead. And there's a lot going on. We'll look at the euro in a sec. The euro's hitting 12-month highs today, euro dollar. So we'll take a look at that. Stock markets have been a bit dull, but a bit of volatility yesterday. So we'll have a look at that as well. And the strategy thing we're going to do today is moving averages. So a classic trend following approach to markets. I have to say I'm not a massive fan of moving averages, but maybe you'll find it useful. So we'll take a look at some of the theory behind moving averages, and we'll look at it on some real markets as well, and you can see how that might work with your own particular trading. So we'll have a look. Right, I think that risk warning has been up long enough. Before we get started, a quick word from our sponsors. So Ayondo have got an offer on. If you deposit 3,000 euros or the equivalent up until the 7th of July 2017, you get access to a signal service provided by 3 markets. So that's chart-based trading signals, daily trades, quick position management, all of that. You can see the details on the slide there. So normally this costs just under 600 euros, but you get it free of charge for 6 months if you put 3,000 euros in your account. So if you go to ayondo.com/en/3 markets, you can find out a bit more information about that. Okay, let's take a look at what's going on. Let's start with euro dollar. I've been away for a week, so I've just been catching up on what's going on this week. But this is Trade Hub. This is Ayondo's trading platform. So this is a daily chart of euro dollar, and it did look, I think, when we were looking at this, maybe May and June, so mid-May to early June, it looked like maybe we were seeing the potential for a top, but I think that's been blasted away the last couple of days. You can see that was the move yesterday. That is a chunky old move yesterday, and we're trading now just below the sort of the 114 mark. I think it's interesting up here. I wouldn't necessarily be in a hurry to be a seller of the euro just yet, but we are getting back to what has been a bit of an area of a problem for it in the past. If I could draw my lines correctly, hold on, let's pick that up on that high there. So June last year, around about 114.30, let's say, and so the ultimate resistance, immediate resistance, is probably up there, just above 116. But at the moment, it's a market that's still strong. Would not want to be going short into the sort of strength that we've seen over the last couple of days. But let's flip it over to the hourly charts and see if there's any levels. So I think at the moment, following that break, you can see the size of the move from yesterday, and it hasn't really looked back. These are the hourly candlesticks we're looking at. But for me, any weakness for now still looks to be a buying opportunity. The problem I always have, I think I've mentioned this before, when a market runs away like this, where do you place your stop loss? I mean, clearly, if it dropped all the way back to where it was yesterday and shows some strength, it's a good opportunity to get in. But I think when it's run away, as strongly as it has, I think it's a difficult one to try and get in on the trade. But we'll see. We'll see what happens when it's moved. What is it? A couple of hundred points, 175 points or so. I mean, one strategy. I'm going to talk about this a bit more in a sec. But I suppose an aggressive strategy is to place it under the most recent low. So we flip this over to a 10-minute chart. So if you thought the euro was going to blast higher from here, let's look at some levels. We got levels from late last night, New York time, or actually just after New York, sort of 9:30, 10 o'clock UK time. So that level there, so 113.30 sort of area, about 45 points below where we are now. So if you thought the market was going to blast higher, I think there's one logical place for a stop. But we'll see what happens. But I think from a charting point of view, I think, make no mistake, that strength that we've seen is a significant one over the last couple of days, and has I think, taken away any potential of a top that we were seeing here. Maybe people were thinking about, I don't know, maybe a potential head and shoulders, that sort of thing, but the market's blasted straight through. And I mean, it wasn't showing any signs of weakness. You know, it'd been a bit of a dull month so far, but this old support, you know, was doing a good job of stopping any weakness. So let's see what happens. So we've got these, you know, these targets on the upside. So the immediate one, 114.30, so about, what, 60 points away, 50 or 60 points away from where we are now. If it blasts through there, you'd guess there's a lot of people be looking to covering shorts as well, and maybe looking out for a move to 116. So it's a really interesting market. But I think at the moment, any weakness, you know, definitely looks at a buying opportunity. If we're going to take a longer term view, you know, I think our chart looks something like this, going back to the trend that I think we've picked up on previous webinars this year. There's our sort of medium term trend for euro dollar, going back to December last year, and even if it did start selling off, you can see there's a lot of scope, but it still remains within that trend. So euro dollar still very strong, and if we did get a dip, it looks like a buying opportunity. Let's take a look at pound against the dollar, because that's been interesting. Obviously, the last couple of weeks we've had the election result, which was something of a shock. I think that the Tories didn't end up with more seats, so we saw a bit of volatility. I mean, we saw that the market nosedive when those exit polls came out at 10 o'clock on election night. Then we've had the start of the Brexit negotiations, but so we've seen a bit of volatility, I think, for the pound. But saying all that, I don't think it changes the bigger picture. So let's just look at the big picture first of all. I think the recovery that's been in place this year is still intact. Like the euro against the dollar, it's a long way away from its longer term trend line. You know, it's coming in around about 123.50 at the moment down here, with the market trading at 128.20. So we're nearly 500 points above that longer term trend. Let's flip it over to an hourly and see what this sort of corrective phase looks like from May. So let's flip it over to our hourly, or maybe 4 hourly. Let's start with a 4 hourly view. Here we go. So you could argue, I mean, my bias is I think it's going to go up. You know, I think the story for the rest of this year is going to continue to be one of pound recovery, but clearly it's not going to go up there in a straight line. So we've seen quite a strong move over recent days, and I think the fact we've broken through these old highs, these old sort of short-term highs from mid-June, around about 128.20, is bullish. But you could argue that that trend is still down for now. You know, so there'd be no hurry to be a buyer just yet. But if we start pushing through 129, it does look like that this corrective phase thing has been shaken off, and we can start looking for maybe a move up to the 130. So it's maybe one to watch at the moment, but I would definitely be looking for buying opportunities rather than sort of a big short from here. But let's see how it performs. I think if we drop back. If we did drop back over the next few days, 126 to 126.50-ish, it looks interesting because that has provided good support. So for those of you who just can't wait to buy the pound, I think if we did see it drop down to those levels, it looks like an interesting opportunity. I think Friday, is it Friday? Friday morning, we've got the latest UK GDP data, so the latest revision, because when the GDP, the economic data comes out, we get an estimate, then we get a couple of more revisions, and I think it's the final one on Friday, and I think it's expected to show that the UK economy grew by only 0.2%, so we could see a bit of volatility on Friday morning. But I think for me, the bias is for the pound to move higher, but clearly at the moment we're still in something of a corrective phase. Right, before we have a look at any more markets, let's have a quick look at some strategy stuff. So what I'm going to do my less than artistic scribbles. So hold on a second. If I flip that up, let's see if this works. So we're going to talk about moving averages, and like I say, I must admit it's not one that I use very often, but it's I think it's a popular one with investors. It's a popular one, you know, with some people when it comes to trading, trying to catch bigger trends. So let's just go through the theory. Just first of all, just to confirm, can someone just type in that what you can see now is me scribbling on what looks a white piece of paper, just so I know that thing is actually working and you can see what I'm talking about before I start talking about it. If someone could just type yes, perfect. That's very good, thank you very much. So the theory is with moving averages, so we have a market that does something like that, and then something like that. So it goes down, then it goes up. So this is the raw market price. And if we plot a moving average on this, a moving average is a really simple thing. So all a moving average is an average of the price over a certain period of time. So if we used, for example, a 20-day moving average, so the value of the 20-day moving average today is the last 20 days closing prices, typically, added up and divided by 20. So it gives us an average for the last 20 days. And every day this gets recalculated. So our moving average on the chart, might look like this. So the red line is the moving average. Let's say it's a 20-day moving average. And of course, what happens in a downtrend, when prices are getting lower and lower, the moving average is always going to have a higher value because the moving average is taking into account previous prices that were higher. So in a downtrend, the moving average lags behind the price. And then in an uptrend, when the market's going up, the price might be here, and the moving average will be here because again, it's taking into account these lower prices from before. So it's what's known as a lagging system because it lags behind the market. So it's not a leading indicator. But when the market changes from going down to going up, then the price and the moving average have to cross over. So from a very simplistic trading system point of view, it's this crossover that gives us the signal. So this is called a single moving average crossover system. It's basically when the price moves above the moving average, it's signaling it's going from a downtrend to an uptrend. And if the price up here, let me just change the color. Oh, my screen has decided to die on me. Perfect. All right. Let's just say, right, if the price does that, then that's the sell signal when the price crosses below the moving average. So that's how it works. It's great if you have markets that are really trending, but where it can get messy, if a market is going sideways, then the moving average and the price are pretty close together. So you'll get lots of crossovers and lots of false signals. So good in trending markets, not very good when markets are going sideways. And the problem is, of course, you don't know when a market is going to stop from being a trending market and go to be a sideways market. But let's take a look. As usual, let's have a look in the real world. So let's flip it back to our monitor screen. There we go. Let's stick with the pound for now. Let's take it back to a daily chart. So let's look at the bigger picture, and then we can have a look at something a bit more short term. So this is our pound against the dollar daily candlestick. Let's plonk on our moving average. So we'll go up here, and we'll go all the way down. So there are lots of different variations on moving averages, like exponential moving average, weighted moving average, but we will stick with the simple moving average, which is here. There we go. Click on that. So simple moving average. So what we actually, it's defaulted on mine to a 20-day moving average, which I've just managed to delete. So let's put it on there. Yeah, load default. There we go. Let's put it on. Let's try that again in a second. So you can tell I never use moving averages because I don't know how to put them on. There we go, simple moving average, perfect, there we go. So we've got our 20-day moving average on the pound against the dollar. So looking at this, and you can see exactly what I'm talking about. When the market trends, the moving average sits there and clocks up lots of profit. So if we go back to September last year, the pound was moving higher, the moving average was below the price, the pound reversed, bang, that was our sell signal. So the price moves through the moving average. The textbook way of doing this is to wait for the close. So you wouldn't have got short till here. So you're short at 130 on the pound in September. And lo and behold, we had that flash crash, didn't we? The pound falls off a cliff, moving average stays short all the way down and then covers it at around about 123. So you make 700 points. Easy money with your moving average system. So then it reverses. So the moving average is what's known as a stop and reverse system. So it's always in the market. It doesn't have the intelligence to stay out. So it's always long or short. So then it closes it short, buys in down here, wherever that is, 122.50, 122.70, buys in, rides it up, goes short here, so take some profit, goes short, gets stopped out for a loss, and you can see this is where it gets messy, this bit here, where the market goes sideways for maybe a week and a half. The moving average is buy, sell, buy, sell, buy, sell, buy. Sell there, good signal, closes it and goes long, but only for a day, then reverses the next day and you see again when the market goes sideways, a little bit choppy. And the signals we've had this year over the last few months, buy signal in April when the pound started moving, so buy signal just below 125, closed it out up here about 129, bit messy again, and the latest signal was yesterday. So the latest signal from the moving average, the market was falling, the moving average was falling, but our buy signal came yesterday. And if you'd have bought on the close, you'd have been buying roughly where it is now, 128.20. So that's how it works. You know, it's good in trending markets, not so good in other markets. Clearly, you know, you can vary things. You can if we change the period. If I make this, what shall I make this? Let's say a 50-day moving average. So what happens with a 50-day moving average? Because you're taking into account more data, it lags the price even more, and the advantage of that is you do not get chopped around so much when the market goes sideways. But look at this here. It gave you the same short signal, but it got out of it a lot later. So it's much later in getting into and out of trends, but it avoids a lot of the messiness in the middle. So as ever, I think in trading, it's always a trade-off where if you want fewer trades, you can definitely do that by fiddling with your moving average value, but it will get you out of the profitable trades and into profitable trades much later. You can see it changing as I move the value down. You can see the moving average trading. If I made it a 5-day moving average, so in effect a 1-week moving average, look how tight it is to the price. Let's zoom in so we can see it a bit more. But you can see a 5-day moving average tracks the price incredibly closely, so it gets you into trends. Like the buy signal didn't come yesterday, came last week. Gets you into trends much quicker, but because it's closer to the price, look at this messiness here. Buy, sell, buy, sell, buy, sell, buy, sell, buy, sell. The only person making money there is the broker making it on the spread. So that's how moving averages work. I'd say 20-day is a popular one because it's what is that? It's a 4-week moving average, isn't it? From a trading point of view, it's a 4-week moving average. In the stock market, 200-day and 50-day are popular moving averages, but that's how it works. Let's flip it over to an hourly chart. Let's change this chart now to an hourly because, of course, oh, that's 4 hours. Sorry, because traditionally, of course, it's on dailies, but there's no reason why, if you're a fan of moving averages, you can't use them on hourly charts. So here we go. There's an hourly chart, so 20-hour moving average. So again, it's looking at the closing price over the last 20 hours. Again, does okay on the big moves. It does okay. It catches the big trends pretty well. So the latest signal we have, well, it bought down here. What's that? June the 27th. That's yesterday. So bought yesterday down here. Let's plonk up the crosshairs. So it bought here 127.27 yesterday morning at 8 o'clock. Would you have got taken out? It didn't quite close below. So technically, if you're following the moving average on the close, you came pretty close to getting taken out that trade and reversing this morning, but you're still in. So the market's at 128.20. The moving average bought yesterday at 127.25-ish. So you're up about, what's that, nearly 100 points, 95 points on that. So that's how they work. Like I said, I'm not a massive fan of these, but in terms of a simplistic way of identifying trends, you know, it's not all that bad. Another alternative way of using them, way that some people will use them, is almost as support, and we can see that did work in the early hours of this morning. If the market falls back to its moving average or rallies up to its moving average, like here in a downtrend, maybe it's going to be a level where it finds a problem. So that's it. That's the theory and the practice of how moving averages work. They don't work all the time. They work well in trending markets. They will get chopped left, right, and center in sideways moving markets. But maybe it's something you might want to add in to your own trading and make your own mind up. Don't take my word for it. What do I know? What do I know? Maybe it will be part of the magic system for you. Okay, so let's take a look at stock markets. I think the FTSE's been interesting. I tweeted this morning, the FTSE, but let's take this out to a 4-hour chart on the FTSE. Let's leave our moving average on there just for the hell of it. So let's just remind ourselves first of all on the dailies where we are with the FTSE. I think the trends since the presidential election last year still very much intact. Any sell-offs technically still look to be buying signals, buying opportunities, sorry. So our trend, if we're going to plonk our trend line on, looks like that on the FTSE. So coming in around about the 73.50 mark on the FTSE at the moment, which is interesting because the market for much of the month of June has really gone nowhere. So let's take a look on the 4-hourly chart, because I put this on Twitter this morning. You know, if you've attended these webinars before, you know what a big fan I am of the big levels. And we've got you know, really obvious support level underpinning the FTSE recently. So running some sort of 73.70 through to 7400. This whole, whenever the market dips down or has dipped down, we've seen the buyers step back in, and we saw it yet again this morning. This is a 4-hour chart. So for about sort of from the open this morning, we saw a push lower into that 7400 area, and the market's bounced back about 30 points. So in terms of a level to watch for trades, it's clearly a big one. You know, I think if we started to see this support being lost, then we have to worry about the potential for a much deeper correction, you know, maybe down towards 7200. But for now, at the moment, this level, sort of 7380, 7400, has proved to be good support. Take a look at US stock markets. If we have a look at the S&P, first of all, this is interesting as well. It's been an odd market, the S&P. I mean, I pay a lot of attention to the S&P, and I normally have a trade on for something or other. It's been really odd where it's almost, I don't want to say boring, but for June, I think it has been pretty boring. It has this run out to fresh all-time highs, June the 19th, so a week ago, and then just gives it all back again and goes back into the range. So it's really range bound. We did see a bit of excitement last night. It sold off quite heavily yesterday, but look where it's left us. Let's flip this over to an hourly chart. Here we go. Let's just zoom this out a bit. So for me, despite the sell-off yesterday, you know, taking it a good 35 points below those all-time highs that were set, we've got again another really big level to watch. You know, if we're looking sort of down here, 2415-ish on the S&P, on the cash, is a really big level to watch, and we have seen it 9 o'clock this morning when that FTSE was pushing lower. You know, S&P pushed lower as well, down towards 2416, and it's held. It's rallied, you know, 9 S&P points off that level. So I think that's for the day traders out there. If we did see a bit of weakness this afternoon, back again to 2416, 2418, it looks like a buying opportunity. But at the moment, like European stock markets, you know, US markets, I think, remain strong and remain well underpinned by this support. Again, if we start to lose that, there's other support as well. So I'd still be, you know, famous last words, I'd still be a buyer of weakness of US markets. We've got support on the S&P back out at 2400. So I think there are some big levels to watch down there. And I mean, the DAX, the German 30. I know the DAX is popular with lots of European traders. I think it's a similar sort of story. If we flip it out to a 4-hour chart, you know, we've got quite choppy markets. But again, on the, you know, all of these indices at the moment have these big levels that have been set over the last sort of month, 6 weeks. On the DAX, it's 12,500 near enough that have underpinned any weakness and seem to bring the buyers back out. So I think it's only if we see these big levels start to crack that things might get a bit more interesting for the short sellers and see the pressure build up. Let's see what happens. On the subject of big levels, I know I talk about this a lot, about the importance, I think, of the previous day's high and low. I've talked about the bond a bit in the past. The German bond, I think it's an interesting market. If you're a chart-based trader, it's an interesting market, sort of T-bonds and the German bond, to trade, because it's quite a technical market, but it got absolutely clobbered yesterday. I think it was the biggest sell-off in 400 days that we saw in bonds yesterday, after grinding steadily higher for the past sort of couple of weeks or so. So I'm in a trade now this morning, just basically, again, looking at the big levels, looking at how I'm buying into a downtrend, admittedly here, you know. So, but looking at how the market has performed this morning, and it's a fairly, you know, simple setup with an obvious place for a stop. But this chart isn't loading a short-term chart, but it dribbled down to about 162.80, rallied about 40-50 points off that level, and came back to it again and held. So I bought in at 162.90. So I'm a big fan of trading off these big levels, because they give us an obvious place to set our stop loss. That doesn't want to load, that chart. Let's flip over on something else. We'll wrap things up by looking at oil. I think oil is another interesting one, because there's been, my charts have gone crazy. Hang on a second. I've seen a lot of, I think, pessimistic talk about oil in the last couple of weeks, and I think it's always interesting when a lot of the chatter and a lot of the commentary about a market is one way. Very often the market will do completely the opposite. So this is Brent crude. So my bias on oil is still up. I must admit, I would have thought oil would have made more progress than it has this year. But you can see maybe why, you know, the talk has been so pessimistic. It's come from end of May about $54, $55 a barrel to $45 a barrel last week. But for my money, once again, you know, big levels. We talk about the big levels. We've got just massive chunks of support after it got clobbered last year down to $26 a barrel, then more than doubled as the year went on. We've got these big levels of support running. This is on the which contract is this? This is the August contract for Brent crude. So we've got big levels running from $41.50 up to sort of $43.50. So again, I wouldn't necessarily be in a hurry to be a buyer of oil down here, but you know, the mid 40s, if it's going to reverse this weakness from anywhere, I think this is the place, you know. So let's just plonk our moving average on and see what the moving averages tell us. Here we go, simple moving average. We've got 20-day moving average. So there's our 20-day moving average. And again, it's done quite well on oil because we've had good trends. Not that well beginning of this year because the market was so choppy, but it would have gone short end of May. And it's still short at the moment. The market needs to break and close 47 to reverse this short on the moving average. So I think we could, if we do see a bit of chop down here, but we see these levels hold, I think it's an interesting one. So I don't think it's one for the immediate here and now, but it's maybe one more to keep an eye on over the next week or so, the price of oil, because I think there's a reasonable chance, based on how these levels have held in the past, that we'll see the market start to find some support down here. So we'll start wrapping these up there. I think there's lots to watch. Clearly that euro strength is a big story over the last couple of days, out to a 12-month high, plenty of barriers, not a million miles away from where we are now. Stock markets have been hit a bit in the last few days, but again, we've got those really big levels to keep an eye on. And oil, because it's been so pessimistic, but we have seen it recover over the last week or so, and I think the mid-40s has been such important support. We'll wrap things up there. As usual, if you have any questions, you can drop me an email. David@tradeafter.com is the best email for me. You can follow me on Twitter for market updates and charts and stuff throughout the day @JonesTheMarket. And Aondo are maybe better known for social trading, where you can copy other traders. And I've been running a public social trading account since the beginning of February. I've just done an update this morning. It's up 7.7% copying other traders since the beginning of Feb. So I've just done an update this morning and adjusted the risk. If you go to www.tradeafter.com, you can see my thinking behind that. And I think it's really interesting, social trading, because it's a low risk, low stress way of gaining some exposure to the market. So you can read a bit more about that there. But we will wrap things up there. We'll see what happens. We could see some pound volatility on Friday when that GDP data comes out. We'll see how that goes. But I think plenty to keep an eye on, and we'll do it all again the same time next week. So have a good week. Thanks for coming along, and hopefully see you next week.